Imagine opening a position and watching a steady stream of interest payments hit your account every single day. It operates like clockwork. You get paid simply for keeping the trade open, completely independent of whether the asset's price ticks up or down. In the currency markets, this mechanism is called the carry trade. You borrow capital from a country with rock-bottom interest rates, and you use those funds to buy a currency from a country offering high interest rates. For decades, traders have hunted for the widest gap between two nations' rates, making the New Zealand dollar versus the Japanese yen one of the most famous playgrounds for this strategy. Collecting that daily swap fee feels like generating money out of thin air, but the precise economic forces that manufacture that yield also build a hidden trapdoor, one that regularly collapses under amateur traders. The New Zealand dollar's value is deeply tied to the nation's commodity exports, like dairy and lumber. When global markets are optimistic and growing, investors are happy to buy the kiwi. It thrives on confidence. The Japanese yen sits on the exact opposite end of the spectrum. It functions as the world's premier financial bunker. When global panic strikes, institutional money aggressively buys the yen for safety. This chart shows what happens when those two profiles collide during a sudden market shock. A geopolitical crisis or a terrible economic report hits, investors dump risk assets to hoard yen, and the NZD JPY exchange rate plummets in a matter of minutes. That single vertical drop erases months, sometimes years, of the daily interest you patiently accumulated. The divergence in risk appetite that pays you every night is the exact same trigger that can liquidate your account while you sleep. Surviving this trade requires dissecting the mechanics beneath the chart. The daily interest gap doesn't exist by accident. It is entirely engineered by the opposing policies of two central banks. The Reserve Bank of New Zealand has a history of fighting domestic inflation by hiking interest rates. Those higher rates reward anyone willing to hold capital in New Zealand dollars. Meanwhile, the Bank of Japan has spent decades holding its rates at zero, or even in negative territory, to stimulate a sluggish domestic economy. Borrowing yen costs almost nothing. When global markets are calm, you capture that wide gap between the RBNZ and the BOJ every single day. And because confidence is high, the value of the New Zealand dollar naturally climbs against the yen, adding capital appreciation on top of the interest. You capture yield while the asset itself grows in value. But this rare dual profit environment only survives as long as the macroeconomic weather holds, which makes perfectly timing your entry critical. Buying blindly into a massive upward spike is a reliable way to lose money. You have to wait for the pair to establish a clear, long-term uptrend on the daily or weekly timeframes. This chart shows the mechanics of buying the dip. Instead of entering at the peak, you wait until the price exhausts itself and dips to meet a dynamic support level, like the 50-day moving average. To increase the probability of a bounce, we look for confluence. When that 50-day moving average aligns perfectly with a key Fibonacci retracement level, like the 50% or 61.8% mark, you have a highly defensible entry point. Once you're in, the job shifts to monitoring the exits. If you see the price slice through a major upward trend line, or the 50-day moving average drops below the 200-day, the momentum has broken. Drawing lines on a chart won't guarantee what happens tomorrow. It simply pinpoints the exact entry where the mathematical odds are stacked heavily in your favor. Treating the carry trade like a savings account you can ignore is a rookie mistake. Professional execution requires constant defensive management. This chart shows your first line of defense, the trailing stop. As the exchange rate climbs in your favor, the stop loss automatically ratchets up behind it, locking in your capital gains while still giving the price room to fluctuate. Your second tool is strict position sizing. The distance between your entry point and your stop loss has to dictate exactly how much currency you buy, completely removing emotion and greed from the equation. You calculate the lot size so that if a sudden panic hits the market and triggers your stop, it caps the damage at just 1 to 2% of your total account balance. When you chase high yields, extreme market shocks are a mathematical certainty over a long enough timeline. Strict risk management is the only mechanism that ensures you survive a crash to trade another day. To execute this properly, you have to scrutinize your broker. Because you hold these positions for months, you need a highly competitive swap rate and margin requirements that won't lock up all your available capital. You also have to factor in the cost of market friction. During major news events or the low liquidity rollover period between sessions, spreads can widen aggressively, and slippage can easily skew your entry and exit prices. That is exactly why serious traders use FXNX. With 0.0 pip spreads, premium positive swap rates, and NX AI charting tools, you get the institutional-grade technology required to map and manage your positions with precision. Exploiting the interest rate gap between New Zealand and Japan takes discipline, but when you combine an understanding of macroeconomic forces with a sophisticated platform, the carry trade is a highly calculated